What is the SSI Savings Penalty Elimination Act? This week, we'll be looking at the Supplemental Security Income, SSI, program, which hasn't been updated in almost 40 years, and some legislation that finally looks to update it. The Supplemental Security Income program is one of two U.S. federal assistance programs run by the Social Security Administration. SSI is designed to provide financial resources to support disabled and older individuals with limited income and resources. It was created in 1972. The other distinct program that's run by the Social Security Administration is the Social Security Disability Insurance SSDI program. SSDI provides benefits to disabled individuals based on their work history and contributions to the Social Security system. The amounts received by individuals under SSDI are variable as they're based upon past earnings and how much they've contributed to the system. SSI is also variable and is meant for individuals that don't qualify for SSDI, usually because they haven't worked enough to qualify for the benefits under SSDI. SSI aims to assist those who have limited financial means and resources and can't meet their basic needs. To be eligible, individuals must have little to no income, little to no resources, and have a disability, blindness, and/or be older than 65. What impacts the variable SSI amounts? Program members' amounts might be lower based off different factors like their income, family members' income, and their living situation. Each month, individuals part of SSI must report their wages, their other income, and changes to their resources or living arrangements. For example, SSI payments are reduced by around $1 for every $2 earned from work. That can mean a job, self-employment, or any other money-earning activity. Also, money from non-work resources like disability benefits, unemployment payments, pensions, lower payments by around $1 for every $1 received. If an individual lives in someone else's house, their SSI might be lowered by up to a third of the year's maximum payment. For context, the maximum SSI monthly payment for 2023 for an individual was $943, and for a couple, it was $1,415. Now, let's talk about the heart of the issue. Currently, individuals receiving SSI benefits are limited to $2,000 in assets, and married couples receiving benefits are limited to $3,000. A really interesting piece of this program is there's a marriage penalty. The couple limit is 25% less than the limit for two individuals if they were individuals. Resources that count towards the asset limit include cash, bank account balances, retirement accounts, mutual funds, stocks, bonds, a life insurance policy, household goods, and other personal property that might hold value. Anyone exceeding the limit that has not been adjusted in literal decades is immediately disqualified from the program and stops receiving their benefits. The heart of this bill really comes from the fact that having such a low limit impacts the ability for these Americans to save and prepare for financial emergencies and be able to retire. So what does this bill do? The SSI Savings Penalty Elimination Act is a bipartisan bill, which means it's supported by both Democrats and Republicans, and it's also supported by over 370 organizations. And it aims to update this asset limit for the first time since 1989. The resource limits were updated from the original 1972 values of $1,500 for an individual and $2,250 for couples to the current values back in the 1980s. This SSI Savings Penalty Elimination Act raises these caps to $10,000 for individuals and $20,000 for married couples, getting rid of that marriage penalty as well. The bill will also index these limits to inflation moving forward, which will hopefully help avoid issues like this in the future. This bill is a good step forward in helping people plan for their future, as well as the unexpected. There are studies that show that allowing people the opportunity to try to save a little bit more does not have a serious impact on program participation. The changes outlined in this bill will only increase program eligibility by 3%. That means 3% of people who have lost their eligibility would now become eligible, and these limits would allow people to save a significant amount more. This low impact to eligibility means it will not cost the government an exorbitant amount more to run. It does, however, allow beneficiaries to save for unexpected expenses without endangering their qualification for the program. What do you think about the bill and the program? Are these limit changes enough? Comment below.